Hello. Hello, guys. I'd like to welcome you on our webinar. Please, if you can hear me, just open your chart window and type yes if you can hear me in the chart window which you see. Okay, guys. I'm on air. I'm just sharing my screen. I need you to confirm that you can see my screen right now. I see that there are a lot of registrants were registered for the webinar, but I cannot see many people right now attended. So just what I need from you is I hope you can see my screen. I will show you that there is a chart window, and I need you to type yes or I can see you or anything that can suggest that you can see my screen so that we can start a webinar now. Okay, all right, that's great. I see that some of you can see me, and I'm kind of showing my screen. So, all right, I guess that that there are not so many of you right now, but okay, all right. And that's really strange that there are no place to write, but people can see me. All right, maybe I can, just hello everybody. I can type hello everybody. I can type in the chart window myself, and maybe you would see what I typed, right? And maybe you would see the place where you can type yourself, right? I at least hope so. I do apologize for a slight delay, but we do have some technical issues in here. Anyway, I do have some suggestions that you can see my screen and everything is working correctly. And I guess we can start. All right, I'd like to apologize a little bit for my voice. I got a bit sick recently, so my voice may not sound as proper as it should. I do apologize for that. And first of all, I'd like to tell you that my name is Yuri Safrono. I'm a professor at Belarus State Economic University. I do work as a professional trader and equity manager from 2009. I'm a professional trader, and I'd like to share my personal experience with you. First of all, I'd like to tell you that the webinar is sponsored by HYCM. And let me briefly tell you some facts about the company. HYCM is one of the most recognized names in the Forex industry, boasting a 40-year operational history and is regulated by two of the world's leading financial jurisdictions, FCA and HYCM, with a long track record of providing its global customer base with an outstanding and trustworthy trading experience. HYCM offers clients everything that they need to make informed trading decisions. HYCM has accumulated a large collection of awards since its inception, including World's Finance Best Mobile Trading Platform 2017 and Global Banking and Finance Review's Best Forex Broker UAE in 2017 as well. Its recognition as an industry leader has helped to evolve as an online broker of choice for traders across the globe. HYCM offers clients excellent trading conditions, great liquidity, and low spreads, delivering a super efficient service. with its strong focus on fast execution and low-cost trading. Always a leader in embracing cutting-edge technology, HYCM strives to stay ahead of industry trends by adopting the latest technologies to cater for its clients' evolving needs. All right. The next one, which I do need to tell you, is a disclaimer. This is a must-do part. Please do not be offended, but that's what we need to do. Disclaimer: any opinions may by personal to the author and may not reflect the opinions of HYCM. All expressions of opinions are subject to change without notice. This material is considered marketing communication and does not contain and should not be construed as containing investment advice or an investment recommendation or an offer or a solicitation for any transactions in financial instruments. HYCM makes no representation and assumes no liability as to the accuracy or completeness of the information provided, nor any loss arising from any investment based on recommendations, forecasts, or other information supplied by an employee of HYCM or a third party or otherwise. All right, guys. So far, so good with the official part we have done. And right now, I'd like to share my insights with you about the trading. And today's our topic, as you've seen on the on the slides, is indicators to read trends, and direction. So far so good. I did not make any PowerPoint presentation with the prepared in advance slides to show you, but I would prefer to show how these indicators work in real life market. So that's why I have a live HYCM account in here, and yeah, I have not prepared anything just yet, but we're gonna go through together, and we're gonna discover it at a time. So I would rather analyze widespread currency pairs such as Euro USD or British Pound USD. But recently, if you've seen or analyzed it yourself, either Euro USD or British Pound USD are not trendy. In here, you can see a daily chart, right? And in here, you can see that the pair is basically going from one side of a channel to another. If I'll bring it just like that, you can see that it bounced from one side to another and goes sideways. It's not trend, it's rather a flat market, so it's not appropriate to analyze those currency pairs with trend indicators. That's why I would prefer to analyze in other currency pairs such as Australian dollar, Canadian dollar, or USD CAD. So both of these currency pairs on the daily time frame, you can see that there is a strong trend, and it's quite possible to analyze those ones on any time frame. I would also say that I prefer to analyze the currency pairs on 1 hour time frame, 4 hour time frame, and a daily time frame. Of course, it's possible to use those indicators on a smaller time frames, but the effectiveness of it would be much less um, than on 1 hour time frame at least. So the first indicator is going to be a moving average. Let me just build it. In order to build an indicator, I know that many of you have experience on Forex, but I'm also aware that some of You who visit webinar today have no experience in trading at all, so I'm going to be, showing some basic features of at least how to build an indicator. So in order to build an indicator, you have to put insert indicator. We use a trend indicator, and here you can find a moving average. In here, there is a period of moving average and a type of moving average. And what I would use, the best periods I use on 1 hour and 4 hour time frames is 50 moving average and 200 moving average. So I would build a 50 moving average in green color in here, and I would build 200 moving average. Let me choose the color, like dark blue one, and make it a little bolder in here to build it like that. Okay, let me briefly tell you what moving average is. Among the most popular technical indicators, moving averages are used to gauge the direction of the current trend. Every type of moving average, commonly written in this tutorial as moving A, is a mathematical result that is calculated by averaging a number of past data points. Once determined, the resulting average is then plotted onto a chart in order to allow traders to look at smoother data rather than focusing on the day-to-day price fluctuations that are inherent in all financial markets. The two basic and commonly used moving averages are the simple moving average, the one we've built right now. The type of moving average is can be seen right here, which is a simple average of a security over a defined number of time periods, and the exponential moving average. You can choose this type in here. You would see that it would slightly change, slightly, not a lot. Yep, like that. I do prefer myself, I'm sorry, a simple moving average, but you can use an exponential moving average if it works better in your trading system, no problem. All right. The most common applications of moving averages are to identify the trend direction and determine support and resistance levels. Like in here, you can basically see that starting from this point, both of the moving averages are sloping downwards, both of them. That suggests that the trend is bearish. So the clear definition of the bearish trend, if looking at the moving averages, would be the highest or the slowest, it's called the 200 moving average, the slowest one. It goes on top of the slowest moving average to on 50 moving average and the price. And the price is below both of the moving averages, which should be sloping downwards. So this situation is a clear indication of the bearish trend. So because I told you that the 200 is sloping downwards, 50 sloping downwards, and the price is sloping downwards. And the order is that the slowest one is on top, in the middle is the fastest one, and the price is at the bottom. And support and resistance levels. This is a really nice example of how these moving averages work as a resistance levels in this situation. Like in here, you can see that the price goes down, but as soon as it touches the moving averages, it goes down. Then it touches it back again and goes down. And it goes many times. You can build a really nice trading system only using those moving averages, only selling it when it touches the slowest moving average and putting stop loss a bit above the slowest moving average in here and following the trend this way. You see? That's a really nice one. In here, the trend was the bullish, and it was also acting like a support level in here, and in here as well. All right. Moving averages lack current price action because they are based on past prices. The longer the time period for the moving averages, the greater the lag. Those at 200-day moving average will have a much greater degree of lag than a 20-day moving average. I can build a 20-day moving average for you to see how it looks like and how different it is from 200 level. Let's make it yellow would be, let's make it, what's, you see, it's coming. I'm really sorry, but I have to ask Kate, if you're online and connected to the webinar, can you please mute your microphone because I can hear anything that's happening in the office? Okay, thank you very much. All right, the very first one, the 20 moving average in here, you see how it kind of acts resistance level or support level, but it's too fast. It's too fast, and in here it really fast follows the price, and that's why it less representative than those two ones. But if we use a daily time frame, let me show you. In this case, this is a really nice parameter. It's better to use not the 20 but 24 because there are 24 hours a day, and on a daily time frame, it would be much better to use this one. At the same time, you see, it's not really reliable on this currency pair as well. So I would not advise you to use this. But the higher the parameter you choose, the more reliable it becomes, but less signals it generates. In this situation, like 1 hour time frame, if we simply delete this one, let me just show you. Okay. If we delete a 50 moving average and let's say leave only 200 moving averages, it would be much, the signals which generate, they are more reliable. In this case, it bounced from the MA and went all the way up. In this case, it bounced from moving average and went all the way down. Yes, that's correct. The signals are much more reliable, but at the same time, there are not many signals generated. If we add a 50 moving average in here, you see that many more signals are generated. At the same time, they are less reliable. All right. So it's not the only way how we can use the moving averages on the trendy market, because that's let's see. There are 4 ways to use moving averages and the combination of moving averages in order to benefit from the situation on the market. When a MA grows, you can open buy positions. That's the first and the basic rule. Of course, it's true. Like in this situation, basically we see that they both are sloping downwards, and we can sell pretty much at any time because the trend is your friend, and it's really nice to follow the trend in any particular moment. If we would sell it from this point, even not it's not touching the MA, but simply it's going down, and in this situation we see a clear bearish trend development. and we can simply sell it from here. It's also a good way to, to interpret that, but the results would be, less less than if you wait for it to touch the moving average. So the next one, if MA falls, you should do the opposite. In the momentum when price rise, you can buy. In this situation, yeah, you can see this as well. So both moving averages are rising, and you can simply buy it from basically any particular moment, but it's better to wait until it touches the moving average and you go all the way up from a really nice entry point. The second one is when moving average goes smoothly and only a little hesitates. This speaks of a market without trend. So let's just scroll it a little bit. Like in this situation, this particular situation, you can see that I told you that the order of the moving average in order to determine a trend should be the slowest moving average on top, then the fastest moving average, then the price. In this situation, everything is mixed. Like the moving averages are mixed between themselves and they're mixed inside the price channel. And this suggests that there is no particular trend in this situation. There is no particular trend. So you cannot make any trades based on the moving averages order and their crossroads and interceptions, or like the price touches moving averages and you want to sell or buy. It's not possible in this situation because it's not a trendy market. So in this situation, it's better to wait until you see that the trend appeared. And when it appears, then you can start, using this old rule of when it bounces, you buy or sell if it's a bearish trend. So as I said, another one is to determine trend is good, and depending on interception of lines, we can judge that there is change of trend. That's a very good option as well. So in this situation, we see that the trend is bullish. It's a clear bullish trend. But when the moving averages they intercept between each other, we see that the trend reversed. It changed its direction. It was bullish and then it became bearish. And we basically see it clearly. Let me choose the other currency pairs in order to show it that it doesn't work only for Aussie Canadian dollar, but for other currency pairs as well. In this situation, it's more complicated, but we can see it as well in here. Let's see. So there was a clear bullish trend in here, right? Then there was an interception. So we can keep in mind that the trend is changing its direction. It's not a bullish trend anymore, or at least that's either a correction or it's the flat market stage. In here, the bullish trend a little bit continued, but then intercepted once again, which suggests that the trend is basically over. And then it intercepted the third time, and boom, what we see a clear bearish trend in here, and it continues. It's a current situation, so it's a live market. So we see that it works. If I scroll it a little bit in here, you can see that the situation would be like that. So it was a bearish trend, interception, bullish trend, interception, bearish trend, interception, bullish trend in here. This is a correction stage. And then it basically works for any currency pair, but there should be a trendy market. not a flat market as well. All right, so far so good. We spent a lot of time for moving averages. I hope it was good for you, but we need to move forward. And the next indicator would be Bollinger Bands. Let me just delete those indicators which I have. And Biele Bollinger Bands. All right, the period 24, you can use it 24. It's like 24 hours a day, so it kind of makes sense. You can do it 48 as well, so it would be more reliable, but would generate less signals. Let's do an example with 24. Okay, let me just scroll it. All right. A Bollinger Band, developed by famous technician trader John Bollinger, is plotted 2 standard deviation away from a simple moving average. Bollinger Bands are a highly popular technical analysis technique. Many traders believe that closer the prices move to the upper band, the more overbought the market, and the closer the prices move to the lower band, the more oversold the market. John Bollinger has set forth 22 rules to follow when using the bands as a trading system. The squeeze is the central concept of Bollinger Band. Let me just, this is the squeeze in here. Also, if I can scroll it to here, this is a squeeze as well. The squeeze as well. The squeeze in here. So the squeeze is a central concept of Bollinger Bands. When the bands come closer together, constricting the moving average, it's called a squeeze. A squeeze signals a period of low volatility and is considered by traders to be a potential sign of future increased volatility and possible trading opportunities. Conversely, the wider apart the bands move, the more likely the chance of a decrease in volatility and the greater the possibility of exciting a trade. However, these conditions are not trading signals. The bands give no indication when the change may take place or which direction price could move. Approximately 90% of price action occurs between the two bands. Any breakout above or below the bands is a major event. The breakout is not a trading signal. The mistake most people make is believing that the price hitting or exceeding one of the bands is a signal to buy or sell. Breakouts provide no clue as to the direction and extent of future price movement. Bollinger Bands are not trading system. They are simply one indicator designed to provide traders with information regarding price volatility. John Bollinger suggests using them with 2 or 3 other non-correlated indicators that provide more direct market signals. He believes it's critical to use indicators based on different types of data. Some of his favorite technical techniques are moving averages, divergence, convergence, or MACD, which we would study in the next webinar, on balance volume, and relative strength signal index RSI, which is also part of our next webinar. The bottom line is that Bollinger Bands are designed to discover opportunities that give investors a higher probability of success. So basically, what Bollinger Band gives us a signal, it's also an indication of whether there is a clear trend on the market or whether there is no trend. Like in here, there is a squeeze, and you can see that the market is rather flat. That's from one point suggests that in this particular moment, there is no trend on the market, and it also suggests that that the market will soon become trendy by breaking one of the borders of the Bollinger Bands, and the moves would be really um, huge. I mean, it would be substantial. We see that the difference between those two it's 30 pips, and when it breaks below the border of the band in here, it right away in several hours it goes twice as much as the border between those two bands. So, as I've already told, please don't make a mistake when you see that the price, let's say in this situation, touches the border of the channel, and you say, all right, it broke it, I'm gonna buy from here. No, it's not correct. It may touch it a little bit, go above it, and then return back. So this indicator is just a good sign for us to understand if the market is trendy or not, and to focus on the future movements and to concentrate on the profit which we can get from this future movement. Okay, the next indicator would be a parabolic system, also called as SRR. Let me build it for you. It's also in trends. It's a parabolic. You see that the parameters are steps, maximum, and the color and the type of line. Let's keep it standard. So what we see here, the parabolic SRA, or it can be called SAR. The parabolic system is a technical indicator that is used by many traders to determine the direction of an asset's momentum and the point in time when this momentum has a higher than normal probability of switching directions, sometimes known as a stop and reversal system. The parabolic was developed by a famous technician, Welswalder, a creator of a relative strength index, and it's shown in the I'm sorry, in a series of dots placed either above or below an asset's price on a chart. In here you can see those dots. Maybe the color is not really nice. I would use a dark blue one. You can see those dots, right? One of the most important aspects to keep in mind that the positioning of the dots is used by traders to generate transaction signals depending on where that dot is placed relative to the asset's price. A dot placed below the price is deemed to be a bullish signal, causing traders to expect the momentum to remain in the upward direction. Uh, Conversely, a dot placed above the prices is used to illustrate that the bears are in control and that the momentum is likely to remain downwards. The first entry point on the buy side occurs when the most recent high price of an issue has been broken, and it's time to buy. The SAR is placed at the most recent low price. As the price of the stock or currency pair rises, the dots will rise as well, first slowly and then picking up speed and accelerating with the trend. This accelerating system allows the investor to watch the trend develop and establish itself. The parabolic system starts to move a little faster as the trend develops, and the dots soon catch up the price action in issue. And so basically, the strategy of using this parabolic system is very simple. Um, as I've already told, you can sell when you see that the dots are above the price charts. Like in here, you can sell basically at any particular moment in here. when it's above the price chart, and you can buy when the dots are below the price. But there is this tricky stuff in here. Uh, why would selling when the dots are above is a good idea and buying when they are below is not, at least in this particular example? Because as we've already discovered, in this particular moment, the trend with the help of Bollinger Bands and with the help of moving averages, the trend in this particular situation is bearish. And trading upwards when there is a bearish trend is obviously not a really nice idea, because you see that even if the price is above, those are not trend reversals. Those are simply short moments of corrections. And when it's good time to buy, it is good to buy after correction. So when we see that there is a clear indication of bearish trend, let me build those two MAs once again really quick. 51 and a 200 one and different color. Yeah, you see that the trend is basically it's bearish. And you seek for an entry point. Of course, you can buy in any particular in any particular point when you see a bearish trend, sell, I mean. But it's not a really good idea. The good idea is to wait for it to bounce either from moving average, or if we use a parabolic, it's a good time to wait for a correction, like in here. I'm gonna be, in here we see that there is a correction, and when the correction is over and parabolic turned upwards, it's above the price. It's a good time to sell, like in here as well. The correction is over, we sell it. The correction is over, we sell it. The correction is over, we sell it. The correction is over, in here we sell it. You see how it's good to follow the trend. It's basically, I wouldn't say that it's never mistaken. Of course it is mistaken, but it's sometimes, but it's a very good instrument in your arsenal if you use a very simple strategy of combining the moving averages and the parabolic system. You see the correction and you follow the trend. The correction is over, you follow the trend. Basically, it can make some money for you. All right, let's go to the next one. The next one is called Average Directional Index, or ADX. Let me delete those indicators which we have right now and build an ADX. In here it's called Average Directional Movement Index. In some trading terminals it's called Average Directional Index. It doesn't really matter, it's the same indicator with the same parameters and the same calculations, but sometimes they simply skip one word. All right, the period, I would prefer 24, apply to close, color doesn't matter. It would appear not on the price chart, but below the price chart in a separate window. So the average directional index is an indicator used in the technical analysis and is an objective value for the strength of a trend. So it would not show you, the support or resistance levels. This indicator would basically show you how strong this trend is. ADX is non-directional, so it quantifies as a trend strength regardless of whether it's up or down. It's usually plotted in a chart window along the two lines known as DMIs. So the DMI lines, let's see, The plus DMI, yellow, let's make it dark blue. The minus DMI would be, let's make it olive for us to see it. And the main indicator line, let's make it bigger. Black and bold. Oh no, too bold. Okay, like that. So, analysis of ADX is a method of evaluating trends and can help traders choose the strongest trends. When technicians look for patterns over time to confirm a continuation or trend reversal, they often use the average directional index as an indicator. Developed by Wells Wider as well as the previous one, for use with commodities and daily prices, the indicator is also used for forex trading. Wilder used the plus directional movement plus DMI, which we have right here, and the color is dark blue, and minus DMI, which have an olive color, to determine the best course of action. Put together, Wilder created a framework for trading out of the ADX, DMI plus and DMI minus trio of lines. So traders start by using the ADX to determine if there is a trend. A strong trend is occurring when the ADX is over 25. You can basically see that this indicator has parameters, a numeric one, and like for this currency pair, which we have an Aussie Canadian dollar, right now the value is 16. Basically, when it's over 25, likewise, that there is no trend. When it's over 25, there is a clear indication of trend. Like in here, when it's at the 25, I can actually build a line for your convenience. 25 it is. Okay, something like that. When it's above that, there is a clear indication that there is really nice trend on the market. When it's below the 20 level, let me build the 20 level. Something like that. It's this is the indication that there is no nice trend. The trend is either really slow or there is no trend, so it's better not to use trendy indicators on the market. So when the plus DI, the dark blue one, okay, a line is greater than minus DI line, the olive one, like let's see the situation when there is a trend, okay, and this, okay, this one. And the blue, so the indicator line is greater than 25, like in this situation, it's obviously more than 25. The blue line is higher than the olive line, so it's a plus DI line, greater than minus DI line. The bulls have the directional urge. In this situation, yes, this is correct. There is a clear indication of the bullish trend. The opposite situation happens when the minus DI line, this olive one, is greater than the blue line. And at the same time, the indicator is above the 25 line. So this is a clear indication of that. The bears have the directional urge. As with all technical trends, traders use several indicators to confirm a movement. One option is to sell when minus DI is up and the major trend is down. Another option is to buy when plus DI is higher than minus DI, but only when the larger trend is also moving up. In other words, it is possible to use the ADX as a way to time an entry or on a market that is already confirmed to be trading in a particular direction. So once again, when we see that there is a clear trend on the market, when the indicator line is above the 25, we take a look at what is happening. So there is a clear indication of trend, all right? Yes. Then we see the minus DI or plus DI lines. If the minus DI is above plus DI in this situation, we can sell. Basically, when the indicator crossed, there was an obvious situation happening right here. The minus DI was above. We could have sold it from here all the way down. If this situation happens on the opposite side, we see that the indicator starts going upwards, so the trend strengthens, the plus DI goes above minus DI, and we can buy it right here with all possible way up to here. All right? I hope it does make sense for you. It's a really good indicator to see the strengths of the trend and also to see an entry point, which one is better. And the good entry point is when the trend line crosses the 25 line in here. I would also suggest you of using multiple indicators in order, if you are planning to build your trading system using the ADX, it should not be the only indicator which you use, because the entry point should be confirmed by other indicators as well, not just the ADX alone. But that's my personal opinion. If the ADX indicator works for you and just only this one, so yeah, you can use this one as well alone. So, and the last indicator for today would be accumulation distribution. Let me draw it really fast on the chart we have. It's not in trend section, but in volumes trend section. Sorry. And let's see. So accumulation distribution is a momentum indicator that attempts to gauge supply and demand by determining whether investors are generally accumulating or buying or distributing or selling a certain commodity or stock or a currency pair by identifying divergences between price and volume flow. The accumulation distribution is calculated by first calculating the money flow multiplier and then multiplying the money flow multiplied by the period's volume. Find the money. The accumulation distribution line may be used as an indicator to confirm whether a security is trending. If a security in a strong downtrend or uptrend, the accumulation distribution likely follows the direction of the price movements and therefore confirms the downtrends or uptrends. If the accumulation distribution line and the security's price are diverging, it may be a bullish or bearish signal. If a security price is in downtrend while the accumulation distribution line is in uptrend, the indicator shows that they may be buying pressure and the security's price may reverse. Consequently, the security may, or a currency pair or a stock may reverse and the trend up. Conversely, if a currency pair price is in an uptrend while the accumulation distribution line is in downtrend, the indicator shows that they may be selling pressure or high distribution. This may cause the securities price to reverse and turn into downtrend. Let me just show it to you on a couple of examples. In here, so the main idea of using this indicator is, once again, of using divergences. What is a divergence? As I've already described, but in the simpler words, the divergence is a difference between the prices of a security, a stock, or a currency pair, and the indicator. Like in here, basically, we cannot see any divergences. Maybe in the future, in here, so you see that, let me just draw it, trend line properties, and make it a bit bolder. Like in here, it goes downwards. It forms minimums and minimums and minimums, right, on the price chart. On the indicator window, we can see that it's not going minimums by minimums by minimums. It's flat in here. It's flat. Like in here, it's flat. In here, it goes down. That's the divergency basically, and that suggests us that probably, with a high probability, we would say that this bearish trend will soon be over, or can soon be over, right? We cannot say it with 100% definition, but I would say that I'm thinking that this trend would reverse soon because there is a divergence. Let's try to spot another divergence in here. Like you see, that's probably, like in here we can see one. You see, this is almost flat market. In here, it's flat. In here, it's rising. What does it suggest us? That there is a divergence. And in case of such a divergence, you should follow the indicator way. So if the price stays on the same level, but the indicators go up, you should think of a potential bullish positions, not bearish, bullish ones. So you should follow basically not the price chart, but the indicator. Let's try to spot another one. Or we can, choose another currency pair. This one. Okay. Let me delete this one. Like in here as well, right? A small divergence can be seen in here. So it's going downwards, and what we see on the indicator, it's going up. So what I would also try to tell you that probably it will soon reverse from here. It may not reverse all the way up, like it may not go all the way up here, but it may be a sign of a correction. So the market stays in a correction for some time, and then follows the previous trend, which is clearly bearish in here. So in here as well, like in this situation, you see that the price is basically flat, but in here the indicator goes up. So, and what does market do? There was a bearish trend in here. The market starts a correction, and the correction goes in here, until the market breaks a support level in here. But unfortunately, support and resistance levels is not the topic of this webinar, but the topic of, I believe we would discuss it in 2 weeks, the support and resistance levels. This is a good example of it, but not for today. Let me show you another divergence. Like in here, you see not a lot of divergences can be spotted because maybe the parameters which I chosen for this particular indicator in this particular currency pair is not the optimal one, but like in here it's a bit hard to oops, sorry, to spot it, but let me just guide you through one or two examples. Also, in the situation which we've previously discussed, it's not a 100% signal that the market would reverse. There can be 2 times divergence, 3 times divergence. So if the market, let's see, went downwards in here, it formed upwards in here, it doesn't matter that it would reverse right away. No, it can form another divergence, so it would go downwards from here, and it would form a higher high in here. That happens, but triple or 4 times divergence is a good opportunity to enter the market because it's a more reliable signal than 1 time divergence. All right, as I promised, I'm going to find another one. Let's choose another currency pair. And we have to it's basically the time for us to end the webinar, and I have some things to tell you about. All right. Like in here, probably like that. You see, the market forms a lower low and a lower low in here. It's a triple divergence in here and in here. And what we see on the indicator, it's going upwards. It's almost flat, but it's going upwards. In here, the value is 13,000. You see the value, right? And then it's up a bit and up a bit. So it's a triple divergence. And what we see after this triple divergence, what I told you that this is a really good example of the indication, and it goes up, and it goes up all the way up. So it's also a good indicator to follow and to use in your trading strategy. So far, so good, guys. The time is basically over. Now we have 2 minutes left. I'm ready to spend a bit more time with you. If you have any questions, let me just share my not just screen, but and also a control panel. I believe you see it. There is a chart questions in here, and I believe you can type the questions, your questions in here, and I would be happy to answer those questions right now, if you have some. If not, that would be it for today from the informational part. But what I would also encourage you to go through our quiz. We have a quiz. This is the, let me just copy it, the link, and put it into the chart. We have prepared a quiz for you. Okay. You can click on the link and go through the quiz. There are 5 questions. All of them are connected to today's webinar. If you successfully pass through this quiz, you would receive a certification on your email from HYCM. This certification would say that you've successfully passed through the webinar, and you can share it in social media. You can keep it. You can, that's a good encouragement for you. So I encourage you to click on the link and to pass through these questions right now. Let me just see, maybe some questions appeared. Yep. No, unfortunately, I cannot see any questions, guys. So far, so good. Thank you very much for visiting this webinar. The next webinar will happen in 1 week, the same time, same day, Wednesday, 4 p.m. GMT. This webinar would be about oscillators, the indicators which I use to analyze market when there is no trend. And I would have to say that from 60 to 70% of all the time, there is no trend on the market. So I do encourage you to visit our next webinar and study oscillators with us. Thank you very much. Go through the quiz. Thank you for visiting, and all the best for you. Bye-bye.